Welcome to Cummins India Limited Q2FY23 earnings conference call. We hope you're all keeping safe and healthy. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone telephone. I now hand the conference over to Mr. Ashwath Ram, MD, Cummins India Limited. Thank you, and over to you, Mr. Ram.
Good morning, ladies and gentlemen. I'm Ashwath Ram, Managing Director of Cummins India Limited. Mr. Ajay Patil, our CFO, is also on the call with me. Thank you all for joining us on this call today. I hope all of you had a great and safe festive holiday season. We are happy to announce that CIL has achieved the highest quarterly revenue and profits due to strong demand across various market segments and geographies. Now I would like to share the financial results of Q2FY23 through this call. For the quarter ended September 30, 2022, with respect to the same quarter last year, our sales at rupees 1,922 crores were higher by 14% compared to rupees 1,689 crores recorded in the same quarter last year. Domestic sales at rupees 1,391 crores were higher by 11%. Exports at rupees 531 crores were higher by 21%. Profit before tax and exceptional items at rupees 336 crores is higher by 15% compared to rupees 293 crores recorded in the same quarter last year. For the quarter ended September 30, 2022, with respect to the last quarter, our sales at rupees 1,922 crores were higher by 16% compared to rupees 1,657 crores recorded in the same quarter. Domestic sales at rupees 1,391 crores were higher by 19%. Export at rupees 531 crores higher by 9%. Profit before tax and exceptional items at rupees 336 crores were higher by 21% compared to rupees 278 crores recorded in the last quarter. Segment-wise, breakups for the quarter ended September 30, 2022 are as follows. The sales breakup segment-wise are domestic. Power generation domestic sales were 675 crores, 6% increase over last year and 36% increase over last quarter. Distribution business sales were 446 crores, 22% increase over last year and 7% increase over last quarter. Industrial domestic business sales were rupees 250 crores, 10% increase over last year and 5% increase over last quarter. Exports. High horsepower exports were rupees 234 crores, 3% decrease over last year, 1% increase over last quarter. Low horsepower exports were rupees 242 crores, 49% increase over last year and 20% increase over last quarter. With this, I now open the session for questions. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may enter star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Hi, Ashwath. Congratulations on a great quarter, sir, in all-time high sales and EBITDA. So my first question is on gross margin. So despite such strong performance, it's still almost 300 to 400 basis points lower than our historical gross margins. So just wanted your view whether the level of pricing power, so has it receded? Are we still not able to absorb the commodity inflation, or have we rolled back some price increases? Because large part of EBITDA margins is getting justified because of operating leverage, but we still are not able to get back to our historical levels of gross margin of 35 to 36%. So just your views on that. That's my first question.
Thank you, Parikshit. This is a great question. I think the main factor here is that commodities, while they have started softening, we have still not caught up. So we anticipate gross margin continuing to improve over subsequent quarters. We haven't rolled back any price increases. As a matter of fact, some more price corrections are on the way, which have been planned ahead of time. So there is a lag effect of commodities, and we are catching up. It's going to continue to improve.
That's great. So second question is on, you've been highlighting the supply chain issues has been impacting us to the extent of 10 to 15% of demand. So given the strong growth momentum, robust revenue, so if you can just touch upon on the operational side, what is the current capacity utilizations, and also when do you think you will reach the optimal capacity utilization that will call for a capex? So if you can address this question.
We continue to be constrained by supply chain. I would say that the situation has not really improved very much since the previous quarter. It's been getting better, so we are able to get more output out from the existing suppliers and trying to draw down our strategic inventory, etc. But the problems we are facing on some of the critical electronics or some of those critical parts, especially in the higher horsepower nodes of our business, we continue to see those challenges. So with that, our capacity is somewhere between, I would say, 70 to 80% utilized, somewhere in that range, depending on which nodes we're talking about, which products we're talking about. And we are working. There have been war rooms now going on for 2 years. That work is continuing. So we do expect to see the situation gradually keep improving, but unfortunately, we have no news which tells us that this problem is just going away right now. So we are likely to see continued similar challenges even moving forward.
What about the capacity expansion now? Because you said we are between that range of 70 to 80%, and we have seen other MNCs now expanding in India. So given the strong demand both in local and export markets, so when do you think will be the right time for you to start looking at the capacity augmentation?
We are looking at it, and based on the types of forecasts we have and the future demand, we will take the right calls at the appropriate time. But it's not yet there. So we still have plenty of muscle to flex. Even at 70-80% utilization, a lot more can be done with just manpower balancing, etc. So we still have a lot more ability to sweat these very assets before we will need capacity expansion.
Okay. This is the last question, sir, on this CPCB 4+. So are you seeing any impact of pre-buying coming in during the second quarter, or was there any one-off like a data center kind of product getting booked in this quarter? So any one-offs, and how do you read the second half, the pre-buying happening on the CPCB side?
So the good news is that all this time we have been talking about CPCB 4+, that is going to be announced, it's likely to be announced, all of that. So there was a lot of, worry that what happens if it doesn't get notified on time. It's been notified now. The GSR is out as of last week, and so the timelines are frozen. And typically, because there is such a major technology transformation, so there's a major cost impact likely for end customers. So we do think there will be a strong pre-buy sometime in the latter half of 20 or the early half of 2023, and we are planning and preparing for that. So it's a double challenge. One is, you can see we are already supply chain constrained, and then we are going to have to plan for a pre-buy and build inventory for that, and then plan out a transition where everything fades away. So it's quite a bit of tricky and a challenging situation, but we are also optimistic that now there is clarity and things will move forward smoothly.
Okay. And any one-off during this quarter on data center orders? I mean, because numbers look quite robust on the revenue side.
Yeah, so those are data center orders you get in a lumpy manner. So we had similar kinds of orders last year, and we have orders this year as well. We were able to execute a few in this quarter, and there are many more in the pipeline. Data centers is one of those segments which is growing very well for us and is growing very well in the country, and we are likely to see more demand coming out in the future.
Sure, sir. Thank you, and all the best. So that was my question.
Thank you.
Thank you. Our next question is from the line of Deepak Krishnan from Macquarie. Please go ahead.
Thank you, sir, for the opportunity, and congratulations on a good set of numbers. I just had a question on the export front, given how we have done on the LHP side, 49% increase YOY. What is specifically driving this, and what geographies are we gaining share? And further, given that we manufacture in India, China, and US, has any China disruption led to incremental orders coming to the India entity? So any further color on the export front and the detailed breakup among the four segments, that will be useful.
Yeah, so I think as I mentioned in previous calls, Cummins has three major manufacturing hubs for products around the world. The first is in North America, the second is in China, and the third is India. Of course, we also have some older historical plants in power generation, etc., which are based in the United Kingdom as well, which serve some of the European markets. So for certain types of products, especially the low horsepower products, India is the sole supply center for pretty much the rest of the world other than North America and China. So as demand in those markets keeps fluctuating or keeps increasing, all those opportunities come to us. And so we have seen that pretty much all the areas, if you compare versus last year, all markets have grown a little bit. Latin America, Asia Pacific, even Europe, despite Europe slowing down a little bit versus the previous quarter, has continued to grow versus last year. Middle East continues to be strong, and Africa is the one which has been lagging and been struggling for even compared to the previous year. And a lot of it has got to do with the ability to get money out of Africa in US dollars. And because of which, even though there could be more demand, we have held back from supplying product there because you're not able to get money out there. So to summarize, I can say that most global markets continue to remain strong. Europe has begun to slow down a bit as compared to previous quarters.
Sure, sir. And generally, if you kind of look at it, is it majorly all volume driven, or is it, if you look at exports, how would you classify it between volume and value growth?
I think it's a fair mix. Volume is higher. We continue to introduce new products. So as I've emphasized before, earlier we used to have one product for all markets, and we introduced what we call Fit for Market 2.0, by which we began tailoring products for very specific regions. And now we are in the process of investing into what we call Fit for Market 3. So even further customization to deal with competition in specific countries. So it's a combination of mix, product, volume, us gaining share. So this is an ongoing journey.
Sure, sir. Just one final bookkeeping question. If you could just give us the breakdown of exports between LHP, HHP, heavy duty, and MHP.
One second. I'm just putting that up. So typically, we provide that kind of breakup mainly for the domestic market, but to give you a thumb rule kind of calculation over there for exports is it's almost half. 50% is HHP and 50% is everything else. So that's the way we roughly look at the way exports breaks up as of today.
Sure, sir. Thanks for that. And I'll get back on the queue. Best of luck for the future quarters.
Thank you.
Thank you. Our next question is from the line of Renu Baid from IIFL Securities. Please go ahead.
Yeah, hi. Good morning, team, and congratulations for the strong results. My first question is on the gross margins. While you did mention that pricing actions have been in place and you expect sequential improvement in gross margins to continue, but if you look at CPCB4 implementation coming in the next year, there will be changes in cost structure, sourcing mix. So from a medium-term perspective, how should we look at Cummins' journey to getting back to the old gross margin levels of 34%? In the last call, you did mention that you would want the margins, to target the margins to be back in 34-35% levels. So what would be the timeline to get back to those levels of margins and the levers which will help the margin improvement to 33-34% plus levels?
We want it as soon as possible. The reality is that commodities have been slowly coming down, and we've held the pricing. We continue to increase prices in strategic nodes where gross margins have dropped more heavily. So we want to, by the time we launch CPCB4 Plus, and get that into a stable state to attempt to get back to the previous levels of margin. So I'm not talking about 2 or 3 or 4 years. We would want to get to that kind of margins in the next 18 to 24 months.
Sure. And broadly, given that the notification is out, there is more clarity on the final changes required. What is the expected change in the pricing which is expected both for engines and gensets across the major nodes under CPCB4?
I can't give you the exact increase as far as prices are concerned. All I can tell you is that they are substantial. I'll give you an analogy to a different market segment. In the automotive space, when they went from BS4 to BS6, the prices of the full engine plus after treatment system, the cost of those went up by about 50%. So it's likely to not be as high in this because the engine plus after treatment makes up a smaller portion of an entire genset. But it is likely to be substantial because you are changing the technology, and the Euro CPCB4 Plus are equivalent to Tier 4 final emissions of the United States. So they are very, very strict and stringent. So the technology required to do that is pretty expensive. So that's what's going to drive the increase in prices.
Okay. Secondly, if we broadly look at the performance across domestic and export, seems very much resilient to the external market. And you also mentioned Europe has started to slow down. So if we look at exports, you think that 15-20% growth in the export revenues, value revenue should be sustainable? Or you think there could be pockets of contingent impact from the Europe slowdown, which is now looking more evident?
It's very difficult to predict, Renu. With the way the global economies are going, it all depends. If everyone keeps increasing interest rates and multiple economies are driven into recession, then it's going to be difficult to sustain this kind of growth. If things were to normalize, stabilize at certain point, we certainly have a lot more to gain. Even in a slowing economy, I think our aspiration is to continue to grow. So whether that is through gain in market share or through improving more products, even if the overall global economy does not grow, we would still have the ambition to attempt to grow. Now, how successful we are in doing that depends on how well some of our new product launches go, how well we are able to leverage the CPCB 4 Plus to capture some of the other global markets, etc. So it's not a simple answer. Our ambition, of course, is to keep growing at this rate, if not more. But the realities of the way the cycles are going to work in multiple markets, based on global commodities, based on geopolitical crises, based on oil prices, based on inflation, based on the dollar getting stronger and stronger versus multiple currencies. All those are going to play a factor in how some of those other countries are going to be able to compete with us or not.
And have we seen any positive tail impact of the consolidation of global supply chain for ICE engines, which you were expecting to have that started to play out, or you think it still will take time despite the increased energy costs in the Western world?
It's starting to play out a little bit, but you really see these real impact you will see in a couple of years. But we are certainly seeing trends where it is starting to play out more and more.
Sure. And one last, if I can ask, within the industrial segment, rail segment was one where the growth numbers or volume of take has been a bit volatile. So if you can share some of your comments on various segment outlook and in specific for rail business, how are you looking at that portfolio ramping up again?
Yeah, so rail is beginning to bounce back. It's not yet bounced back to the previous high levels, and we hope that we've launched quite a few new products, including getting into the electrification space with our hotel load converters, etc. So we hope to see that beginning to catch up and then beginning to go ahead of where we were in the past. The area where we've been slightly disappointed in the industrial space has been in the construction space. We were expecting construction space starting from the previous year to have a decade-long growth of over 13 to 15% CAGR. The reality is that the spends have not happened, and we have actually seen that market contract a bit and is only now starting to show some signs of revival. So construction is an area which has underperformed our plan. Rail is a segment which is performed sort of on plan, and the other areas of mining, defense, marine, etc., those have all performed better than planned. So that's the way I would classify the industrial market. We remain extremely bullish and optimistic about the future of this segment. It has underperformed some of our other segments, though, in the last year or so.
Right. And just to follow up on the construction, you think the demand impact is also linked to the increase in prices due to CVBS implementation, or it is more in terms of the end market demand?
Yeah, I think it's directly correlated to end market demand, because when you build X amount of highways, you need X amount of equipment. So, when they want to use that equipment, it doesn't matter what the net impact of those price increases are very small compared to the cost of building those roads, etc. So it's the slowdown of funds to build those actual projects on the ground, which is what, in my view, is the reason for it lagging. And we have started to see it slowly start to come back. We hope now it will pick up steam and then continue forward like it had started off in 1920.
Thanks much and all the best, sir.
Thank you.
Thank you. Our next question is from the line of Sangeeta Purushottam from Cogito. Please go ahead.
Yeah, hi, good morning, and thanks for giving me the opportunity. What I wanted to get an understanding was that on the export side, you don't export to the other hubs, that is North America and China at all?
We export some, but we don't export too much of the product there, because one is because of treaties such as USMCA. They have requirements to produce majority of the product within the countries of United States, Canada or Mexico. So it doesn't fit you don't fit the pricing targets if you have to add the duties and then still sell into those markets. That's as far as that is concerned. As far as China is concerned, we sell some products into China, but they also have capacities within China to produce as many products as we can produce, if not more. So the access to that market is limited. Similarly, their products don't get sold in our market, and they could ask similar questions. But that's the way it is, and but it's sold in the rest of the world.
Right. And given that, the China manufacturing facilities all within the same group, would it be fair to assume that you are unlikely to benefit from any shifts from China to India of manufacturing?
I wouldn't say we are unlikely to benefit. We are already benefiting a little bit, because the competition for us in those market segments mainly comes from China. So if customers are going to buy less Chinese products, then automatically they buy more of our products. So not in a direct sense, but in an indirect sense, it certainly helps us.
So what you're saying is that you're benefiting from the non-Cummins producers in China, the shift from there.
That's correct.
Okay. All right.
And we also benefit that from a fact that as a backup to China strategy, things which were single sourced in China are being dual sourced in India, and things which were single sourced in India maybe at some stage will get dual sourced in China. So everyone's become more cautious about having all their eggs in one basket and in one region. So there is a whole bunch of work happening in dual sourcing and risk management.
Right. And in terms of the broad macro drivers for exports as well as domestic, would it be fair to say that over the medium term, that is 3 to 5 years, the domestic drivers are likely to be stronger?
So if India continues to grow at the 6 to 7% growth of GDP, and our own ambition is to grow at 2x of the GDP, so certainly the India market growth rates will be faster than export growth rate, unless our products really work out well and we do a good job on product management and we are able to gain market share. Our global market shares, even though we are the largest power generation manufacturer in the world for gensets, we still have a lot of opportunities around the world. So we do have an opportunity to grow those markets faster as well, but a lot of that is dependent on many other variables, whereas the domestic market is completely under our direct supervision. So we think we can grow that at a faster rate.
Right. Okay. One last question: that with the change in technology, which is likely to happen soon, and you mentioned that there could be a substantial increase in the cost of the gensets, is that likely to impact demand?
So in all of these technology transitions, and we have seen this trend now for, I would say, over 100 years that this company has been in existence. There is this concept of pre-buy, where people buy larger quantity of the previous technology product, and then they hold off buying the product for a little while because they have stocked up on inventory, etc. And so there is a little bit of a lull, and then over a period of 12 to 18 months, it catches back up and goes back to the old historical rate, and you continue to get growth. So these technology changes and price increases, etc., do not impact long-term demand for the product.
Right. Okay. Thank you so much.
Thank you. Our next question is from the line of Bhavin Vithlani from SBI Mutual Fund. Please go ahead.
Yeah. Good morning, gentlemen. A couple of questions from my side. First is, if you could just help us with what are the implications of Cummins in India from the acquisition of Meritor by the global entity, and also what will be the implications for the listed entity. That's one. Second is, more color on exports will be appreciated. If you could give geography-wise breakup of the exports, and how are you seeing the macro trend there. Third question is on the industrial side. If you could give us a breakup, compressor, construction, etc., as have you been giving. And last is, if you could help us with the capacity utilization at the Kothur facility and at our mega site where we source from CTIL and also Tata Cummins facility. More color on the capacity utilization at these entities where we buy the products, just to understand the overall capacity utilizations. Yeah, thanks. These are my questions.
So the Meritor being an axle and brake company acquired by Cummins Inc. globally, has very little impact on the Cummins India business, other than we can now, in the construction and in some of the other heavy duty applications, we can now aspire to sell an entire powertrain solution rather than just selling an engine and an after treatment. So it improves the ability to sell a complete package. So I think those are opportunities. We are just evaluating and trying to figure out where those opportunities are. It gives us a play in and to utilize synergy in some of these segments like construction, mining, where some of those products could be used. As far as I'll first answer utilization and then I'll give you breakup. As far as utilization is concerned, Kothur, like I said, is like at a 78 to 80% utilization, and primarily driven by supply chain, not having enough parts to utilize it at a greater level than that. So as we keep getting more parts and more material, we should be able to push the utilization higher, and we should be able to gain better efficiency also. So we don't see needing to put in more investments for quite some time. As far as utilization of plants, other entities where engines, etc., are purchased from, I would say those are all high volume plants with mega capacities, and I would say their utilization is below 50% as of today. So there is plenty of capacity available for Cummins India were it to need more capacity. So let me get into the details of exports region-wise. So in this quarter, we had Latin America had sales of 116 crores, Asia Pacific had sales of 143 crores, Europe had sales of roughly 70 crores, Middle East had sales of 109 crores, and Africa had sales of about 40 crores. And then getting into the breakup of the industrial businesses, compressor, which is going through a cyclical downturn, had sales of 13 crores. Construction had sales of 93 crores. Mining had sales of 38 crores. Rail had sales of about 40 crores. Oil and gas and defense and marine and all of those put together had another close to 60 crores.
Thank you so much for taking my questions.
Thank you.
Thank you. Our next question is from the line of Dhaval Shah from Alpha Accurate Advisors. Please go ahead.
Hello. Hello.
Yes, please.
Yeah. So, sir, a couple of questions from my side. Number one is when this new version of CPCB 4 gensets will be launched?
The target for when it becomes effective is July of 2023. So they have to be launched by 1st July 2023.
1st July 2023. And sir, once these new versions are launched, do we see a strong export growth from here on? Like then basically the Indian manufactured gensets are at par in terms of the compliance with the global standard. So do we see a strong export growth from there on?
We see access to some markets which we did not have access to earlier. So we do see more access to some cities and some areas in Europe. We do see access to some areas in North America like Canada and the United States where they buy some of our products and they buy some components from us, but they don't buy entire products from us. But we do see better access to some of those. But like I mentioned earlier, there is an offsetting concern that with USMCA, even if we were to be able to do that, we may not be able to still supply entire products, but we may be able to supply subsystems of products. So, but certainly the opportunity should open up more. So it doesn't hamper us in any way because we continue to have the older ranges also in our portfolio and a few additional new markets also open up for us.
Okay. But sir, you indicated that you will not be able to supply the full system. So still there would be some bottlenecks because of the compliance?
There will be bottlenecks because as per USMCA, they have to buy a majority of the product sourced from, for example, in Canada, United States, or in Mexico. So despite the fact that we may have those products, we may even be cheaper, it still may not. They still may not be able to purchase those products from us.
Okay, because of their regulatory norms.
Because of the free trade agreements. Okay. So unless India also signs a free trade agreement which makes it, which gives us exemption from USMCA restrictions, we will not have access to some of those markets without having to pay those anti-dumping kind of penalties.
Got that. Thank you, sir. Thanks a lot.
Thank you. Our next question is from the line of Puneet from HSBC. Please go ahead.
Thank you so much for the opportunity. My first question is with respect to the CPCB. From 1st of July, will you not be allowed to manufacture or will you not be allowed to sell the products of the previous generation?
We will not be allowed to manufacture. Our OEMs and our dealers and distributors who have got inventory which has been manufactured before 1st of July will still be able to continue selling it till they run out of it, I think. And there's a cutoff for that as well. I think it's the end of the year, by which they will not even be able to sell product for which they have inventory.
Okay, so there is a 6-month benefit in some sense.
Yeah.
Second is, if you can also talk about, you said that you don't need to increase capacity, but you may need to add labor. Can you also elaborate on how much labor would you need to add if you were to take the capacity utilization to 100% from current levels?
One is certainly we'll have to add labor. We are also, over the years, we have been bringing in more and more automation. So we can increase efficiency a lot more without adding too much labor. So we continue to work on semi-automation to improve efficiency, to improve quality, to improve safety, and those kinds of things. So I cannot give you an exact number. It depends on how the demand is, because different lines, whether it's assembly, whether it's big engines, smaller engines, medium engines, depending on the type of mix, the amount of labor required on which project will vary. But it's, I don't know. If I were to take just a thumb rule kind of guess, it's maybe 400-500 people will be needed to get to 100% utilization.
Okay. So what I'm trying to reach is, will we get some operating leverage once the demand goes up on account of labor, or that's you?
Yeah, always. We always get leverage on labor. We get leverage on utilization of fixed cost assets, everything.
Okay, that's helpful. Thank you. And last one is, you also talked about the shortage of parts. What are the parts where you're feeling still a bit of shortage? And
I can tell you the biggest composition of those are based on electronics, and those continue to be in crisis. They continue to be on allocation. There are other specialist parts which need some special materials coming out of countries like Ukraine, which are also constrained, and so as alternate capacities are being set up, those parts also get constrained. A lot of that has got to do with fuel system parts, some specialized castings, etc. So majority, I would still say, is electronics-based parts, but it would be unfair to say that it's only electronics. There are quite a few other things also which are constrained.
Right. And any sight of the shortages easing or you getting higher allocation?
It's been getting better every quarter, which is why we are able to do better every quarter for the last, I would say, 7-8 quarters. But I do not have a clear answer on when we think the problem will just go away completely. Big investments are being made by players to set up alternate capacities. The moment some of those start to kick in globally, I think this crisis should resolve itself.
Oh, that's all from my side. Thank you so much, and all the best.
Thank you.
Thank you. Our next question is from the line of Mahesh Bendre from LIC Mutual Fund. Please go ahead.
Hi. Thank you so much for the opportunity. Sir, you mentioned the data center opportunity seems to be decent in Indian market. So, what is the current contribution to this particular segment to our sales, and what is the outlook for that going forward?
I won't give you the exact breakup in terms of value, but I can tell you that it is one of the fastest growing segments. If I look at the power generation market, the top 3 segments for us in the previous quarter that grew were data centers, pharmaceuticals and biotechnology, and overall manufacturing. And so we've had the highest number of large genset shipments ever in our history for data centers, commercial realty and manufacturing. So that gives you a kind of indication of how strong this market is, and we don't think this market will slow down for at least a couple of years. We think that this can be sustained, this growth.
Sure. And sir, what is the capital expenditure plan for next 2 years?
Capital expenditure is in line with what we've been doing for the last, and as we have clarified, the big capital expenditures that we used to do in the past, we are behind those. We have been doing roughly about somewhere between 200 and 225, 200 to 250 crores kind of capex spending for the last few years. A big chunk of that is driven by sustenance capex, just to keep the things going, to upgrade things, etc. Another big chunk goes into growth projects where we develop new products, launch new ideas, etc. And the bigger other chunk goes into engineering. So we expect to be in that kind of band for at least for the next 2 years till we get to that point which others have been talking about, where capacity utilization is so high that we feel we need to put in more capex to grow capacity from a long-term perspective.
Sure. Thank you so much, sir.
Thank you. Our next question is from the line of Lavina Quadras from Jefferies. Please go ahead.
So thanks. My question has been answered.
Thank you.
Thank you.
Our next question is from the line of Aditya Mongia from Kotak Securities. Please go ahead.
Good morning, and thank you for the opportunity. I wanted to first of all stress a little bit more on the distribution segment. This segment appears to be probably growing faster than product sales over 1H. And while we've been reading about in the annual report endeavors of yours to grow, it would be good if you could kind of bucket down what all is firing for you. Is it more, let's say, offering more services to your existing installed customer base? Is it more competition's customer base that you're able to kind of create and get inside? Or maybe, let's say, is it more because auto linked spares and services sales are going up? If you could just give some color, it will be very useful.
Yeah, so to in one line, it's all of the above, and so we have seen we've been putting in tremendous focus into this segment because we feel that what we are entitled to and what we have seen as Cummins' entitlement in other markets, it's been lower in India, and so there has been a lot of focus to improve the availability of parts for customers. So parts have been growing in multiple segments. We are doing more reconditioning and recon, and that's greener, better for the environment, and is better value for customers because we provide a warranty on all rebuilt and reconditioned products. So as utilization increases, the distribution business also grows well. So mining is now working 24/7 in India. So because of that, our business is growing. So service business is growing, parts business is growing. We are getting more contracts. We used to do just the engine. Now we do, let's say for rail, we do the entire the powertrain, including the whole compartment. So we are expanding services. We are adding more product lines. We are reaching out to more customers. We are bringing more out-of-fold customers back into fold. We are offering more products, and also we are because of the impact of commodities, etc. We are also increasing prices. So the combination of all of those is resulting in a pretty steady growth, and we think more can be done as far as this segment is concerned.
That's really heartening to know, and thanks for the color. The second question that I had was more on this comment that you had made that we want to play a catch-up on gross margins. Now, as I understand, if I, let's say, take the average from, let's say, FY 2017 to 21, the gross margins today are probably 400 bips lower. Are you suggesting that this kind of decline that has happened in the last 2 years can be kind of fully covered up over the next 18 to 24 months, as you suggested?
That's what we're going to attempt to do. Whether we are successful or not, you all have my comments, and then you all can grade me on our scorecard. But that's the ambition. We seek to get back to better growth margin because that's what we think we are entitled to from the kind of quality of the product as well as the services we provide to customers. Now, like I said, it's easy for me to make a statement like this to all of you. people on the ground have to do a lot of work. It's got to do with cost reduction, it's got to do with engineering, it's got to do with product management, it's got to do with getting better realization from the market. So I think a combination of all of this is how we plan to get back. And of course we get to reprice with CPCB 4, etc. So that's going to be our ambition. How well we succeed is for future calls for us to analyze on.
Sure. I'll just probably have a follow-up question over here, and I think this is important for us to understand. See, if I was to be comparing your return ratios, and that's one parameter of assessing how better you can go from here. They are already kind of at, let's say, 2015 levels, wherein CPCB 2 had not happened. The company was doing fine in terms of competition. Everyone was earning decent margins, including competition. And since then, we've seen A, returns fall down because competition played spoilsport, and B, then you as a company starting to do something more micro in nature, managing your cost better, and managing your product portfolio a lot better, especially on the export side. Now, with already you operating at decent returns at depressed gross margins today, and these are like 20% plus if I do ROIC calculations, do you see scope of doing more micromanagement of margins, which means you doing something that competition cannot kind of come up with, and thus exploring better gross margins / EBITDA margins / return ratios?
Yeah, we are a product technology company, and we have always won around the world when we have introduced product technology which is more reliable, more robust, more durable, provides better TCO for customers. So as always, we will continue to work on the product side to help give us those kinds of advantages. And we continue to focus on the fixed cost side, the variable cost side, on how we can continue to get efficiency year on year on our labor, efficiency year on year on our white collar folks. So so it's possible. I guess that's what good management is all about, to say how to make that happen. It's not going to be easy in this kind of volatile environment, but that's what we are aiming to do.
Thank you, sir, for the color. Extremely happy to see numbers play out the way they are, and wishing you all the best.
Thank you.
Thank you. Our next question is from the line of Priyankar Biswas from Nomura. Please go ahead.
Good morning, sir. So my first question is regarding this CPCB 4 tech transition. So what I understand is the customers still have a window to buy, let's say, the older products after, let's say, 1st July 2023. So till distributors have stocks. Is that the correct understanding? And if so...
That is correct.
If so, then how can we, are we be able to take up the price hikes that are necessary for a CPCB 4 engines, since the customer still has the option to buy something, let's say, which meets his requirement and still at a relatively much more affordable?
Right. So the first is, right now there are certain nodes which are already capacity constrained. And so even if somebody wants to build up inventory and then wants to buy product, it's not going to be available post the July time frame. In all of the other nodes where extra inventory or material can be available, people will be pre-buying and they will be buying more material, and they will stock up. And our hope is that we have got more pricing increase coming in the future, and we are hoping that commodities will soften further. So the combination of price increases, holding on to price increases, and commodity softening, the combination of both of those is what we hope will play in our favor to continue to hold or improve margins.
So, sir, the reason why you are asking is, so clearly some of your competitors are behind you on the technology curve as far as CPCB 4 is concerned. So wouldn't it make rational sense for them to actually overproduce in this period so that they have a lot more older products inventory? since they cannot reasonably expect to compete with you on CPCB4 at least in the very near term.
Yes, and that would be what I would do if I were in their shoes. Unfortunately, that unconstrained supply of raw materials is not available to anybody. So even today, if we could produce more of everything, we would be producing more. But the supply chain cannot meet up with that kind of spikes in demand. So yeah, it will happen. In some nodes, it will happen, and we will have to deal with that for 6 months. But in many nodes, it will not happen, and the transition will happen sooner.
So just a add-on question here. So in the past, like if my memory serves me right, with the transition to CPCB4, we were kind of expecting that with the 5G opportunity in China, probably we could see some uptick in sales, or maybe something in the North America. So in North America, is the parts and components market, how big can it be for us? Like, let's say today you have certain an X level of exports. So just by the parts, because you highlighted the NAFTA constraints, I understand that. So how big can it get?
It's pretty big. I mean, there is no... I can't give you exact numbers as of today, but I can tell you that for us to be able to maintain the rate of growth we have had in the last 2 years, it can be sustained in the future if we were to even just supply components going forward.
Sir, the last question from my side. Sir, you don't give a guidance, I understand that, but I think your parent gave a guidance of something like a 20% growth for the calendar year for the entire India business. So how does that translate for us, essentially, based on the parents' commentary only?
Yeah, so you can take that as sacrosanct. So that's the kind of growth we are aiming for. We still do not provide a full guidance, and we will probably get started in future quarters from providing that guidance. But we remain cautiously optimistic, which means order boards are good. We are waiting and watching to see if the impact of all of these global turmoil is going to have any negative effect on us. But if it doesn't have too much of a significant impact on us, then we will continue to perform the way we have been performing in the last 6 quarters.
That's all, sir. Thank you so much.
Thank you. Our next question is from the line of Dipesh Agarwal from UTI Asset Management. Please go ahead.
Yeah, good morning, sir. So my first question is, if we see in India, a lot of your peers are setting up electrolyzer or fuel cell capacities over the next 2-3 years. I understand you have an ambition out there, but to be cost competitive, do you think Cummins will also have to set up a facility soon in India? And if so, which of the Cummins entity will house the manufacturing unit?
That's still being evaluated. So certainly we will have to set up in India to be cost competitive in India, also to meet the Make in India, PLI, those kinds of guidelines we'll have to produce in India. What's being evaluated is what's the best way to produce. Whether it makes sense for Cummins to set up its own capacities, or whether it makes sense for Cummins to partner with somebody to get the leverage of scale and access to end markets. Those are the kinds of questions we are asking ourselves, and then evaluations are being done on what's the best path to enter from an India perspective from a long term is. So it's still an evaluation, and Cummins has probably more experience in setting up